Hi guys, what's up? Welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. Today, this is another macroeconomics video. We're going to kind of be talking about some recent updates that have come out where we are seeing the Federal Reserve has indicated that by the end of 2022, and depending on when this video went out, once the update series video would have gone out or had not gone out, but we talked about that a little bit. But today we're going to be kind of talking about that, what some of the implications of that really are, as well as there seems to be a lot of misinformation regarding the taper. Balance sheet policy, open market operations, et cetera, and so forth. So without further ado, well, Fabio, what are we looking at here today to start?
All right. So, I mean, I think we've seen the headlines. We've seen people talk about it. The Fed's going to taper, blah, blah, blah. Now, for a lot of people, they don't really know what that means. But what we know is taper is not a cessation to quantitative easing. It's simply pulling that back a bit, allowing rates to rise maybe just a little bit. And then the St. Louis Federal Reserve, like as you said in the other video, you read that they say by the end of 2022, it should be time for liftoff on rates. However, to the extent.
Yes, please. And then I'll.
No. Once you pull out the whole jazz hands.
Yeah. So basically, English. To summarize what tapering is, the Federal Reserve typically conducts open market operations, which is where they purchase treasury securities, mortgage-backed securities, or direct debt obligations to Fannie Mae, Freddie Mac, et cetera, so forth. Tapering is simply reducing the pace by which they are purchasing these. So the Federal Reserve has indicated, correct me if I'm wrong, the number they're going to be tapering by about 5 billion somewhere in June of this year. And then by the end of this year, it's going to be about 10 billion less than what they're currently adding now. Now, the thing is that all throughout COVID, we were seeing what's known as fiscal stimulus, whereby they're purchasing a lot of these treasuries, mortgage-backed securities, as well as the direct debt obligations. This was contributing a lot to, Stephen Van Meter talks about this, as well as some other macroeconomic
Wait, you just said
forces.
Fiscal stimulus.
Yes.
What do you mean by that?
Yeah. So what happens is as they purchase the treasuries and mortgage-backed securities and the direct debt obligations, this reduces the amount. And the idea, and this is actually kind of goes into quantitative easing as well, the idea is that this will then have investors move more into stocks. And what we're seeing here today is that, correct me if I'm wrong, Stephen Van Meter's point is that this is exactly one of the things that's contributing to the massive amount of margin that we're seeing in the markets. The fact interest rates are so low, they're at 0% to 0.25%.
You just presented two different avenues, though. You said,
but they're both very, very much correlated and interrelated to one another as well.
Well, but the margin, the accumulation of margin has nothing to do with okay, so let's say you have a bond and your bond gets bought out, right? Under that assumption, are you now going to go out and borrow tons of margin because they bought your bond?
Yeah, well, no.
Yeah. So the margin debt has nothing to do with the purchase of bonds,
I'm just focusing this back into the interest rates, and then liftoff, as you had indicated earlier, is when they raise interest rates. Basically, so, just for the English there. But no,
So
you're
with
right.
What's causing probably the massive usage of margin, which is probably at its most. Can you actually pull up a chart for us, Austin?
Yeah, let me go find one.
Pull up a chart for us in the audience. But margin debt's at a near all-time high in recorded history for the United States. And that kind of coincides with the drop of interest rates, right? Because if money is so cheap, why not just take it, right? And you could think of margin, or they take it on a margin as like a short position on the dollar. So the dollar is heavily shorted at this moment because a lot of people have borrowed dollars to buy assets, right? And that's essentially short selling, right? Because when you short sell, or short selling is when you borrow a stock and you sell it on the open market, and then you will have to buy it back at a later date. If you buy it back at a lower price, you end up keeping the difference. So basically, when you are buying assets, you're selling a dollar, you're getting rid of a dollar. All right, so here we go. So Austin, thank you so much. So as you can see here, margin debt is, I wish you would pull up actually a longer term chart, but what we can see from here is that there's a massive difference between where we started off at the beginning of the decade and where we are now. And I bet you if you just adjust that for economic growth or economic size, the change is a little even more drastic because the economy did not grow as much as the debt. So the debt has grown faster. And then,
Yeah,
there we go. This is what I was wanting. All right. So let me go ahead and move us so us in the audience can see. Yeah. So that was hiding that. You don't know what I'm seeing, but like it looked to the right, but I moved it to the middle. All right. So what we can see here is the margin debt is at extraordinary levels. And remember, margin debt is callable. It's not a fixed rate. It's also fluctuating rates, but also it's callable debt. It's not like your mortgage on your house where the bank can't tell you to pay it tomorrow. Margin debt's a little different. And margin debt, when it starts to contract, it contracts really fast. So what we saw is through the process of QE, the lowering of interest rates, it engages into the encouragement of borrowing. So it encourages borrowing, and the borrowing is supposed to, create new money. That's where the money is actually created. And a lot of this money was created, and then was used to buy assets, whether it be real estate, whether it be stocks. And this caused asset price inflation, right? So that's what we've kind of been experiencing, right?
Yeah, and that's one of the primary criticisms that a lot of people have for QE is that QE directly contributes to these sort of asset bubbles that we are seeing probably here, especially that this chart is helping show as well, because of how easy it then, well, no, not because of how easy it becomes to borrow, but because of the fact, given the nature of what QE itself is. Now, would you kind of take just a quick second and just kind of re-explain in more standard English what quantitative easing is, and then how that specifically can relate to instances like this, or even then how quantitative easing, as you were just explaining, will sort of relate to contraction of margin, et cetera, so forth.
So quantitative easing, actually, before we do that, I wanted to highlight this, and then I'm going to ask you to reshare the screen, and then I'll answer your question.
Yeah.
Or you know what? I'll answer your question then show this. So keep this up.
Yep.
So quantitative easing basically is a swap. It's an accounting swap that occurs between the Federal Reserve and the commercial banking system, by which the Federal Reserve essentially takes on the liability per se, right? And it swaps it with reserve assets. So when Austin goes to the bank and he deposits $10,000, that is a liability of the bank and an asset to him, right? And so the bank, what it's going to do is it's going to buy some form of asset with very low risk, very short time horizon. So it's probably going to buy treasuries. And then when it purchases treasuries, it is essentially transferring. And again, you might want to, for those watching, you can pause here and then reverse it and then come back, listen to this a couple more times if it's not making sense, but I'll try my best. All right. So when the bank purchases the treasuries, right, they're essentially transferring the liability from themselves to the federal government. So the federal government owes the money on the treasury, right? And then the bank owes Austin his $10,000. So the difference, the bank can pocket the difference, right? The bank can pocket the difference between the interest they give him and the interest paid on to the treasury. Now, this changes a little bit when the Federal Reserve engages in quantitative easing. When the Federal Reserve engages in quantitative easing, they take that asset, which is on the bank's balance sheet, and then they swap it with the reserve asset. And then that treasury goes onto the Federal Reserve balance sheet. So now the owner of that asset is now in the Federal Reserve, right? And the liability, right, if we trace it back a little bit, it still actually is on the federal government because they owe the money at the end of the day, they owe the bond. And it's just basically changing hands. It's accounting. And then the bank has the reserve asset, and then Austin still has his $10,000 at the bank, right? Nothing's really changed there. So what quantitative easing is meant to do is it's meant to cause interest rates to go down. That is the function at the end of the day of quantitative easing. And for the purpose of lowering interest rates, you get a couple of benefits from that. You supposedly stimulate lending growth, because if it's easier to borrow, or not easier to borrow, if it's less expensive to borrow, more people will borrow. That's the idea behind it. So if we lower interest rates, Austin's going to probably buy that house, right? It's going to increase his ability to purchase that more expensive house, right? Because if interest rates are 8%, That's a little different story than if interest rates are, 3-4%. But at the same time, and by that same token, not just him now has the ability to buy the house, but everyone. So the demand for that house can go up, right? Because more people are now able to purchase that house, and that can cause asset price inflation in the housing market, for example. So cap rates, right? We discussed this in our REIT video. Cap rates will come down, right? Because a greater ability to purchase those assets and a greater desire to purchase those assets. That is the sign of quantity.
The lowering of interest rates will lower the cost to borrow, because for those of you who don't know, when we say interest rates, that specifically refers to the federal funds rate, which is the rate that the banks charge each other for overnight loans. This kind of plays into the repo market as well, which I'll kind of talk about that a little bit later. And then also I have a couple questions actually in regard to reverse repos and how that kind of plays into this whole thing as well. But apart from that, the other thing that's kind of prudent to note is that the FFR is one of the most important interest rates, obviously for good reason, in the entire world. It influences the prime rate, which is the rate that customers can get, that banks will give their best customers, so their customers with the best credit, the most assets, et cetera, so forth. And the thing about the FFR is that the federal government, I've read some things here, correct me if I'm wrong, that in March of 2020, the federal government no longer required you to hold reserve assets. However, why would you take out more on an overnight loan than the interest on reserve balances as the upper floor of the FFR? Like, why would you take out more than what the FFR is effectively offering on that loan? So that kind of incentivizes people to hold those reserve assets, if that kind of makes sense with what I'm saying here. And then I correct me if I'm wrong. They do not require you to hold reserve assets, but why would you not hold reserve assets when otherwise it's more expensive for you to borrow than when you can just borrow directly from the FFR? And then they also include a second contingency whereby you can go to the Fed's discount window. They typically do not try to have you do that. That's like a kind of a last case resort. So they disincentivize you by raising interest rates to the level of the interest on reserve balances as well, which is, as I just indicated, the upper floor of the FFR. Now, my question is here, and just so I don't go on a tangent about repos, I'll kind of briefly explain what repos are. So repos, the repurchase agreement, is effectively the most common type in the United States, at least, is the TRI agreement, whereby a big bank acts as a broker between typically a money market fund, which has an excess to lend, and then a financial institution, albeit a hedge fund, let's say. What happens is, and correct me if I'm wrong, because this can get quite confusing, the hedge fund comes to this money market fund and says, okay, we would like to have some cash, let's say $500 million in cash, not billion. And then we're going to pledge these treasuries as collateral on this cash. And then overnight that reverses, and that 2% to 3% that was pledged on collateral from those treasuries are the profit that money market fund is effectively making on this specific thing. And that's what repurchases are. Those are the lower floor of the federal funds rate. Now, my question here is, what are then reverse repos? Is this the federal government stepping in saying,
Fed.
Yes. And then also, how do reverse repos contribute to quantitative easing, or even so much so here, what we're seeing, this massive amount of asset bubbles? Do they contribute to asset bubbles? Is that something that we would also see typically when it comes to reverse repos as well? Like, would you kind of briefly explain a little bit what reverse repos are, and then some of the other things about
not to dive too much into the weeds, but to answer the question in a way that probably is pertinent to what we're trying to discuss or say, I would say that the repo system actually allows or helps the Federal Reserve manage liquidity pools within the financial system. So when QE gets a little overboard, for example, actually, people need to understand this first. If the federal government, we're in a pickle. The United States is in a pickle where it actually needs to continuously borrow in order to provide liquidity for the very system it has then created, right? And the Federal Reserve utilizes its tools in the repo market to try to provide this liquidity sometimes when QE gets a little out of hand, when they take away too many treasuries off of the market and into their balance sheet. They need to then provide the financial system with these treasuries in one way or another. So that's what those tools allow them to do. When you have you get into the problem where you can have a liquidity crisis, which they've managed so far to avoid. But going back to like the notion, the United States itself has created this for them. Yep.
Something I actually want to know, there's many different forms of liquidity crises. Like for instance,
yeah.
there's also there's a camp of
Pull 'em up.
economists
Pull it
that
up.
are actually saying, I will, but
Pull it up.
there's a camp of economists that are actually saying that we are higher inflation will actually help when we're in a liquidity crisis. And as they define this particular type of liquidity crisis, that's when interest rates are where they are now, 0 to 0.25%. And yet people are still holding their money in savings, which they alluded to was the case because of COVID. You know, a lot of people, at least when COVID was at its worst, March of 2020, people were not exactly investing as much. They were holding more in savings, yet the interest rates were still down. And because of that, they actually were rationalizing that higher inflation would benefit in situations like that. And now I'm kind of wondering, I kind of want to pick your brain. Are they kind of correct in this theory or assumption? And then if so, when you mention liquidity crisis, because I just definitely define it differently than you potentially would, how do you define a liquidity crisis in this instance?
Well, I would say liquidity crisis is, I'll define it. I'll try to define it simply. It's when there's not enough money going around for the obligations that need to be met. And then that can cause a problem where a mass solvency crisis, right? It's almost the same thing, liquidity, solvency. So the inability for the financial system to have a bunch of churn. And so a lot of individuals or entities are unable to meet their obligations because money is tight, basically, for lack of a better term. Money is tight. And I know that, okay, so that person, whoever wrote that, basically they're going down the argument that a lot of people aren't spending. They need an incentive to spend. Well, what better incentive is there than the loss of purchasing power? And yeah, sure, that argument's always been there. So that's the argument for inflationary currency systems. However, there's a bunch of problems with that argument because there have been many moments and periods of time of history when there has been spending. So another problem that I have with it is it's assuming that when people go out and spend, they're going to spend out on consumption. A lot of people actually don't really do that. So for example, if you have $1 million, Austin, in a hypothetical scenario, inflation's going to hit 50% this year, for example. Let's be a little extreme. What are you going to do? What are you going to buy?
So I know that inflation is going to hit 50% this year. I would buy real estate, something, I would probably take my money out of the system and put it into some sort of investment.
Well, no, you see, I have a dispute with that. You're not taking ever money out of the system, but you're buying an asset. You're buying assets. You're not consuming. You're not going out and buying a bunch of toiletries, a bunch of little snacks, a bunch of consumables. You're not buying more TVs. You're not buying more microwaves,
PCs.
Yeah, you're not really doing that. You're thinking of ways to preserve wealth, and so then you go out and purchase a real estate. You don't actually delete money from the system. No. You bought it from someone, and then that someone has to go do something with that money. Now we can prolong the rate at which that money will not be used for consumption. For example, if each person down the line is simply going to reinvest it because everyone is thinking the same thing. They don't want to have their money just sitting in cash, and they'd rather have it, invested and working for them, blah, 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 blah. Then that would have the end result of actually taking money out of the system and can contribute, yes, to a liquidity crunch. But that person assumes that the inflation would encourage the opposite of that, would encourage people to go out and spend it on, I don't know, like TV consumables, consumption. They would consume with that money. I don't think that's the case. I don't think that's the case based off like how people behave, right? I think most people, and you can ask yourself, the audience, what would you do? What do you think most people would do? They would look for ways to preserve their wealth. If, for example, they believe, it's just the assumption that they believe that their money is going to lose a tremendous amount of purchasing power. They're not going to go out and buy a bunch of toilet paper.
Yeah.
Okay.
Yeah. So kind of touching now back to the repos, there's a camp of people when we talk about the 2008 recession that happened in 2008. There's a camp of people that say that the Lehman Brothers failed because of an aggressive.
How did you say that?
Lehman?
Lehman. Is that a Rhode Island
Lehman?
thing?
It is a Rhode Island thing. Don't quote me on that, but it is a Rhode Island thing. But anyways, the Lehman Brothers, they a lot of what contributed to their downfall, at least, was because they were going to the repo markets and because of the amount of cash that they were generating. And then it was something where they weren't able to then pay back that cash. That was what helped contribute to the 2008 recession. There's also a separate group of people too that also say, oh no, actually it was because there was corporate paper and that corporate paper became worthless and nobody wanted to service the corporate paper. And that contributed to the recession. It wasn't the repo market. However, my kind of question is here, what is your opinion on that? And then secondly, what is the role? We kind of touched upon this a little bit earlier. What is the role that the repo market might be playing now into potentially what we might see the market, what we might see happen in the market in 2022 and beyond?
Well, you can summarize everything you just said. Was Lehman went through what we know as liquidity crisis.
Mm-hmm.
There was a solvency issue, right? So
yeah,
whether either camp, whatever you're on, and I'm not going to say which camp is right or which one's wrong because I may be right or wrong. You know, who knows who's right.
It's nuance
regardless of which side, both of them are describing more or less the same thing, some form of a liquidity crunch, right? And Lehman did not have the ability to back up its obligations, right? So what the repo market again is its role in today is actually trying to provide ample liquidity for each of the financial institutions. If they were to fail to do so, we'd have a big problem. So everyone is trying to do a balancing act where the federal government needs to keep borrowing, actually, for a variety of reasons. One, to fulfill its obligations. And secondary reason is to provide liquidity to the markets. And then the Federal Reserve simultaneously is sucking up liquidity from the bond market by buying up, they're not really buying up, but by snatching up all of the different assets, the treasuries, and then sucking up this liquidity. And then they have to keep doing the balancing act because they're trying to lower interest rates. And by lowering interest rates, it also simultaneously then allows the federal government again to create more treasuries at lower rates, et cetera, et cetera, et cetera. And then under the assumption that lower rates will stimulate the economy because it stimulates borrowing, et cetera, et cetera, et cetera.
Mm-hmm.
So where we are today is we're in a position where the lending or the leverage is so high in both parties, both the public and the private sector. The public sector lending is getting to the point where raising interest rates is not feasible because it would then cause the servicing of said debt to be insurmountable relative to the tax revenue that the country brings in. So by all intents and purposes, the federal government is more or less, if nothing changes, is more or less stuck.
Okay. So now this is the big question. This is the video title here, and this is the big question. Do you think the Federal Reserve is going to crash stocks? Do you think that they will crash stocks? Do you think, I know you've indicated before in the past, you don't think that they will raise the interest rates. You don't actually think they will raise the interest rates, but you think that the threat alone will crash stocks. Do you believe the Federal Reserve will crash stocks in 2022, Fabio?
Yeah. So
yeah.
I'll share a lot of the opinions I shared in this article. Mm-hmm. Pretty simple article. I wrote it on LinkedIn I wrote it actually over the course of 2 articles. This one and this one. This was before we ever made any videos.
Professional. Oh yeah. Yeah.
So this is way before we made any videos, and it was kind of outlining some of the trades I was doing in my personal portfolio. Mm-hmm. But regardless, in those 2 articles, I wrote them in, I don't know if everyone saw the dates. It was in March of 2020. What I was describing there is that the Federal Reserve's policies would have caused basically asset price inflation. And that why I was going to say, in the time when stocks were crashing, that I was saying now is time. And then in my second article, which was actually very close, very, very, very close to the bottom, I was explaining why I was selling all my T-bonds because I had purchased T-bonds earlier. I rode up the wave, right? And then I think my T-bonds were up about 20%, sold my T-bonds, and then bought stocks. I was very, very proud of myself of that. But
Okay, so actually, please continue.
uh-huh.
Please.
Well,
Yeah.
with that being said, it was my thesis in the article. I explain it. It's basically that the Federal Reserve policies in the short term, over the short term, was going to cause asset price inflation. I didn't get into the nitty gritty details because it's a LinkedIn article. It's not really meant to go, deep dive. It's not a research paper or anything like that. But
Yeah.
the function of what occurred, what was behind the thesis, right, was pretty much the quantitative easing, right, to taken to the extreme degree, would bring down the cost of borrowing. This cost of borrowing would cause asset prices to skyrocket because you'd have leverage coming into the system, and on a variety of levels, you would allow the government to be borrowing at ever lower rates, and then they would provide a bunch of fiscal stimulus. So that fiscal stimulus would then perpetuate a bunch of short-term inflation. Then you had short-term supply chain inflation that's still going on. So it's probably going to be for, I think 2023 is when I think the supply chains will kind of normalize out there. So all of this coming together actually was my thesis as to why it was a good time to invest in stocks, which is my disagreement with Stephen Van Meter is on his timing. I agree with his thought process, his thesis. And I say that now, knowing that I'm fully invested right now in equities. I'm fully invested in equities. Mm-hmm.
So if I'm understanding this correctly,
For the most part, yeah.
Let's say that we have someone like Jeff Booth, who is a deflationist, that says that the deflationary nature of technology itself that is currently at odds with the debt-based inflationary machine that we have that is causing a divide this way. If I'm understanding this correctly, you're basically implying that Stephen Van Meter, who follows a similar tune, Stephen Van Meter's correct, he's wrong in his timing. However, you are long stocks, or you are long equities just because of this, because you do not think that this sort of disparity that we're seeing happen this way is not exactly going to materialize yet. Therefore, you are long on stocks. Am I understanding that?
Well,
just
I'm a little bit different from Jeff Booth. Jeff Booth is talking about how technology is, going to drive the cost of things lower over time, and that's the advancements of technology. That's good. That's a separate argument. Stephen Van Meter is talking about the financial system and the mechanics of the financial system, and about how quantitative easing will cause a liquidity crisis into the future. I just think he's wrong on the timing. So two different things, because Jeff Booth believes that quantitative easing is money printing. So he believes that the financial system's inflationary, and then that the two forces are fighting against each other. Stephen's the opposite. Stephen is not saying that the two forces fighting against each other. He's saying that we are doing things that, he separates fiscal policy with specifically quantitative easing. And as long as he talks about how borrowing is the source of where money is created, debt is, so if people are not borrowing, even if interest rates are lower or whatever, if people are not borrowing, no money is being created, and therefore you wouldn't have as much inflationary pressures. And he argues a lot of the inflation is from supply chain. So I agree with a lot of what he says, except what I think he was missing out, and as expressed in those two articles, was he underestimated the forces that would drive asset price inflation over the short term. And that's what everyone's been writing. So the beauty of writing asset price inflation is that you can kind of pick any horse or any boat and you'll float. So
it's a good little saying.
Yeah, that's why I was like, no horse, boat, because you can pick any boat and you'll pretty much float with the rising tide. So it was a very easy time to pick stocks. I mean, we've talked about a bunch of different stocks on this channel. I mean, like the inflation ones that some people think are inflationary were the oil companies that I own, ConocoPhillips, which actually just reached an new all-time high. I've been always thinking about selling it, but I'm like, not yet. And
you know what question's coming after you finish your thought, don't you?
All right. No, I have no idea, actually. I have no idea.
You have no idea. All right.
No.
Two questions. Please finish your thought first. But please.
Well, the asset price inflation, again, that he underestimated, I believe that it was going to happen. I think that's what we've seen. We've seen asset price inflation due to the policies of the Federal Reserve, in large part, and a combination of fiscal stimulus that is actually inflationary. And again, Stephen actually says that as well. Fiscal policy can be very inflationary. QE specifically, just specifically cutting out QE from everything else, it's not structurally inflationary. It's very different, but surrounding that, the government's actions can be very inflationary, and then again, supply chains can be very inflationary. So you had that kind of going for you, but a lot of companies don't necessarily benefit their stock prices from the inflation per se. It really depends, but everything is very nuanced. So it kind of depends what you're playing at. All right, what's your two questions?
All right, my first question, and you've actually kind of answered this, but maybe in just like one or two quick sentences, maybe for, just why do you think Stephen Van Meter is incorrect on his timing? You did answer this, but maybe just in a quick, like 1 to 2 sentences. And then also, so please answer that one first. And then I have this one, because this one's going to make your mind, you're going to go on a tangent about this one.
So Stephen, I think, was right long-term. And again, his long-term thesis is hyperinflation in the United States. There's going to be a period of regular normalcy, deflationary pressure causing long-term hyperinflation, and then collapse of US dollar. If what he believes were to come true. I don't want to put words in his mouth, but that's how I understand a lot of what he's been suggesting. But so if he ever watches this video, I'm not claiming to know that or to say that that is exactly what you're saying, but that is my interpretation. Or maybe not hyperinflation per se, but he believes that there's inflation. Or if specific key parts of how the financial system works, such as a crypto by the Federal Reserve or Federal Reserve digital currency, that's when I know for a fact he said explicitly that would be very hyperinflationary, because that would allow the government to actually print money instead of what we currently do. So yeah, just he's wrong on timing because he misjudged how powerful asset price inflation would be. Okay, what's your second question?
The second question is, I've seen a camp of people that say that crude oil is the biggest threat to inflation. What are your opinions on that? I told you. Didn't I tell you this would send you onto a tangent?
Yeah. So that goes after the school of thought that I'll break down why they think that. All right. So that school of thought or that camp believes that is the case simply because if energy costs rise, that's non-discretionary income, and that income will take away from the discretionary income that consumers will no longer have to spend on, again, discretionary goods and services, which in case lowers the aggregate demand of the economy for those goods and services. And then when you lower the aggregate demand, but supply remains somewhat stagnant, the price should fall, right? That would be deflationary. And so that is why they say oil prices being so high is the greatest threat to inflation, insinuating that oil prices is deflationary, or oil prices rising is deflationary. Defending that argument, I can't really defend it. That's basically the argument or the premise as to why they make it. How valid that is, I don't think it's very valid. Okay, so here's the key point. So when oil rises, oil is a necessary cost for all goods and services. No company, right, long term will sell products at a loss because they will go bankrupt. If they sell products at a loss, they'll go bankrupt. So if input costs rise, the costs must be passed on to the consumer. At the end of the day, what will happen is a re-rating of our economy. So for example, the country I come from, Venezuela, it didn't matter that the people couldn't afford the products still rose in price anyway. It didn't matter. It doesn't matter necessarily if you can't afford the product, the price can still rise. So that's my whole problem with that whole assumption that simply because prices rise, right, if prices will then come down because prices rise. It's like, that's correct under a different set of circumstances. So the United States, you also have to remember that United States is a huge import economy. And so the rest of the world would need to desire our current. Yep.
And they are an import economy specifically because we are the world reserve currency now.
Yes. Okay. Correct.
Because if you are the world reserve currency, you have to, I kind of say that a soft have to with more of an added nuance, but you have to be an import economy in that instance because people demand the world currency in that instance.
You have to make sure that dollars are exported, and then you need to ensure a degree of stability for that currency. So the United States has a responsibility to ensure stability as a world reserve currency. But yes, they have to basically export dollars to the world. And doing so, they basically are an import economy, right? You're absolutely correct. Now, if that changes, this is where the big problem lies. If that changes, if any part of that equation changes, we have a really big problem, because it doesn't matter if the people can't afford a product. That doesn't necessarily mean the price will come down. That actually does not mean that. And we have a rising East. We need to remember that the East is rising. We discussed this in another video, that the East is rising, and they're going to increase their demand for goods and services, for resources, and the demand will need to be fulfilled. If they have a greater degree of buying power, purchasing power, or their demand is, more desirable to fulfill, then what is the United States going to do? Well, I don't know. Hopefully the world will still take the dollar, right? And if it still takes a dollar, good on the United States. But it doesn't, again, I will say it again. It does not necessarily matter. It's not a rule of law in nature that a declining purchasing power of people or decline in discretionary income of a civilian population will therefore cause drop in prices. No, prices can simultaneously rise in both discretionary and non-discretionary goods and services. That is completely possible. It happens.
So I've seen before, Kathy Wood, she's indicated that deflation is a very large threat in this instance. Would that be kind of something that you would also, I mean, I'm sure you can understand where she comes from in this position, but is that an opinion that you harbor in this instance as well? Or do you have a counter to this sort of criticism?
This is where I would agree, for example, with Jeff Booth. See, I don't agree with him fully, but I agree with him in a lot of things too. So Jeff Booth, I think he's right on this, because there's been a lot of times in history where deflation has shown itself to be not so much of a boogeyman. Deflation is the natural progression of humanity. We develop technologies, and technologies tend to make things cheaper. That is the expressive measure of wealth. So we did a video where we asked people, what do you define as wealth? And we saw some very interesting responses. I define wealth simply as the desire and ability to acquire resources. So you have to desire, right, the resource. And then on top of that, you have to have the ability to, right?
Yeah.
So if you have both of those, right, because you have to have the desire before you have the ability, because if you don't want something, why would you try to get it? But if you want something,
I would say my definition of wealth is just simply the ability to acquire these resources, specifically because the desire is already implicitly the foundation of wealth itself.
Fair enough. Actually, let's change it to that. It is the ability to acquire the resources you implicitly desire. That's how it works. So that's actually more beautifully put. So
thank you, my friend. Thank you.
So if you see those resources and you're not able to acquire them, then you're not really wealthy. So the measure, the nominal measure of the currency that you utilize to acquire those resources is meaningless, right? So it's, in essence, it's the expressive ability over time to do, to acquire those resources. And wealth can decline, but the nominal rates can rise. So people can make more money nominally, but acquire less and less resources over time. And then that's what I would say is the true measure of wealth. And wealth can transfer from one nation to another as one becomes more powerful and the other one becomes weaker and weaker and weaker.
Yeah.
So I'll say this. For example, if you go to Europe, if you're an American and you go to Europe, you'll notice a lot of places in Europe are extraordinarily cheap to you. So you have to kind of take that and really think about that. So the ability, not all places in Europe, there's a lot of places in Europe that are expensive, but there's also a lot of places that it's extraordinarily cheap in comparison to the United States. And you go there and you look around, and some products, for example, are very cheap and some are, the same. So for example, like a vehicle, a vehicle of comparable size, model, make, and everything can be about the same as the United States. However, a lot of other consumables are going to be extraordinarily cheap to you. So you have the ability to acquire a ton of resources, right? And you also have to consider then look at a poorer nation, right? Because then we can conceptualize what a poor nation is. Take Venezuela. Let's not use an extreme example. Let's take Mexico. So Mexico, Argentina.
Like that.
Well, Argentina just went through hyperinflation. I was trying to avoid a hyperinflation country, but all right, take the average population of Mexico. So the median income in Mexico, and then try to extrapolate from that the ability for them to acquire the resources, and compare that to something like the United States, United Kingdom, Canada, et cetera. And then you can kind of see where I'm going with my measure of wealth. It is the ability to acquire the resources that one implicitly desires. So that being said, again, the nominal rates of economies can grow over time, but the wealth can decline. And that's mainly what we've kind of been trying to grapple with.
Mm-hmm. All right. Well, before I wrap up the show here today, do you have any closing thoughts on if you, I know you already answered this, but just sort of to summarize again in 1 or 2 sentences, do you think the Federal Reserve will crash stocks in 2022?
Oh, I didn't even answer that.
Yeah.
No. Yes, temporarily, maybe, but no, they won't try to do it longer term. The United States, I'll say this, is trapped. It cannot raise interest rates past a certain point. And this trap, no one knows how it will really end. There are many assumptions. I have my guesses as to how this will end, but not certainties. And all I know for some degree of certainty is that the United States is trapped. Mm-hmm. So I let us all together hope that MMT is correct, and that is actually how the financial system truly operates, and that none of this is a problem. The government should actually, in fact, do more of it. What I say by that is borrow more.
Yeah.
And more, infinitely.
You have heard it here, folks. This is sort of our macroeconomics podcast episode where we like to talk about any and all things macroeconomics, the Federal Reserve. You know, we love it. I'm sure you can tell that we love talking about it, but we are your hosts, Austin and Fabio. This is the Capital Mindset Show. Please be sure to follow our Twitter and Instagram at capital_mindset. Visit our website at capitalmindset.org. Please be sure to share the video. Really, really helps out the channel. Like, comment, and subscribe to continue the conversation. And we'll see you guys later. Take care.